Hey, what's up? We're back. So today we're going to be talking about, in my opinion, the three most important aspects of having a trading plan. Number one being understanding the fundamentals of whatever asset you're trading. So whether that be futures, stocks, crypto, Forex, all these. If you're trading oil, commodities, you need to understand what moves these markets, right? You need to understand what direction the market's going, if there's what affects it. So if we're talking about US dollar, it's monetary policy. If it's stocks, it's interest rates or inflation rates. All these different things affect these different assets, right? Number two is going to be technicals. And this is part of like what a lot of people focus on. So we're talking chart patterns, indicators, support, resistance, supply and demand, order blocks, fair value gaps, breaker blocks, all these different things. You need to understand what your strategy is, what works for you, because any strategy is profitable, right? They say that indicators don't work, like they're lagging, which is true, but you could still make a profitable trading strategy out of it if you're using the right risk to reward, making sure your lot sizes or contracts or whatever it is accordance to your risk management, right? And third is going to be trade management. How do you manage your trade? Like, if it's going in the right direction, are you sticking to your stop loss? Are you doing the same RR in and out every single day if you are trading every single day? And these things are what we're going to go into further into this video. So for point number one, we're going to go over fundamentals. Now, when talking about fundamentals, you want to understand what currency or whatever asset you're trading, right? You want to know what causes it to go up. You want to know what causes it to go down. All these different things, right? What I would advise is to always look at the overarching theme of the overall sentiment of whatever asset you're selling or buying. Now, going off that, for Forex, the big things you want to understand are interest rates. You want to understand inflation rates. You want to keep an eye on consumer price index, which is just CPI. This alone will tell you how the economy is doing, how much money is being stimulated into the economy. This also means that given to how people are working, how much they're earning, and how much they're able to spend. So it's a quality of life thing. So the higher the CPI, the better. Lower, not so good. And that tells you a lot about how the entire economy is doing. Same thing with retail. Could be month on month, year on year. These are all very important things to keep an eye on. A good app is Forex News. Tells you when it comes out and tells you if it's good or bad. Now, so you're probably asking, okay, what's good interest rates? What are bad interest rates? So right now, JPY has a negative 0.1 interest rate, meaning it is a very dovish. It's a dovish policy, which in turn makes it weak for investing, because you're almost basically losing money by holding onto Japanese yen, while with US dollar, USD, inflation, I think I talked about this last video, I believe is 1.3, 1.3%. And to combat that, they use interest rates, which I don't speak of. I think it's 5/6%. Might be 6.5. But this is a return on investment, basically, meaning it attracts investors. So as we're looking at US dollar to Japanese yen, it is saying that for $1 you get 148 Japanese yen, or for 148 Japanese yen you get $1. So knowing that if US dollar is strong and JPY isn't, you're going to be able to buy more Japanese yen with a stronger dollar, and that will cause JPY to go up. Now on the flip side, for a whatever pair XX USD, what you want to look at is Dixie. So Dixie, whatever way Dixie's going, this asset, whatever this is 100% going the opposite way, or most likely. And that is a big portion of fundamentals that people need to understand. Another good way is just to look at the 1 day. Okay, what has it been doing? Has it been overall bullish, overall bearish? Then set yourself up in the direction the market's been heading, not against it. Reverse trading is risky. You might take 4 or 5 trades. That could be 4 or 5% of your account. Before you make 6%, 7% on your account, you're only really making 2-3% on your account. In my opinion, isn't worth it, right? All right, now touching on our second point, technical analysis. What I would want anyone to really grasp is the importance of time frame analysis. Understand how fundamentals goes into technicals. In my personal opinion, that technicals is just a tool to get into a good entry in whatever market you're trading. I recommend understanding the fundamentals, like we talked previously, overall trend. Now start from a high time frame and go down to the lower time frame that you're trading at. I would suggest starting at the 1 day or the 1 week, scaling down to 1 day, try to predict in the next day's candle. Once you can do that, you can then scale down to the 15-minute, 30-minute, 5-minute chart, and then look for your plays, really, right? Everyone should have a playbook they go by when making trades. Whether that be an order block, fair value gap, a pattern, if you're a pattern trader, whatever it is, you need to lock it in and do the same thing every single time you go into the market. Me personally, I trade Wyckoff schematic 1. I'm looking for my moves. I'm looking for a spring such as this, a retest before getting involved, right? Before I get involved, I need criteria to be met before I look for my final piece, which is a impulse correction impulse to get into the market. If you're a true trend follower, which I believe everyone should be, this is what you should always look for. Find it anywhere in the market. Every market you can find it in. So we find when things start trending. We have right here, I already did it. When you're a true trend follower, you get the impulse, correction, impulse. Again, impulse, correction, impulse. If you can catch things like that, you can catch trades at 275 pips. There's no reason you can't. If your strategy allows something like that, then there's no reason you should not be following it to a T. Same setup every single time you execute. Also, when you're trading, you should always stick to one pair, at least in the beginning. Master the pair. Understand the volatility of the pair. What time in the day does that pair move the most? Me personally, I'm on the west coast of the United States, so I have to trade JPY pairs or Aussie dollar, because that's the only thing that moves during the Asian market over here during the time that's reasonable for me, because midnight to 7 a.m. is just not feasible. So understand what you're trading, when it moves the most, what's your setup. Back testing is huge. Understanding that back testing and forward testing is your best friend. And having a playbook. That could be you're waiting for it to hit a supply zone, a demand zone, support and resistance on whatever time frame you're using, an order block that's been formed. You're waiting for a certain formation to come off of it. So I could be just waiting for a move down. Say an order block is created here, and then I'm waiting for a impulse. I'm waiting for an impulse off this order block to a correction, and then here I'd get involved. There's no reason to not to, if that's a part of my plan, right? I get in on this next move, recent lows. No reason you should not be doing that. The reason people mess up technicals is because they either overcomplicate it, they don't stick to the plan, or they're just not doing their plan right. I believe you should write out a one page of what the plan is technically, given your fundamentals, and then execute it every single day. All right, so for our third and final part, we'll be going over trade management. Trade management includes a couple different things. It's how you treat your trade when you're in profits, how to treat trades in profit, and I think, well, there are only two real ways to go about it. You can full or partial your way through trades. So partials could be anything like you take half the position off at a 1 to 2 or at a 1-3, whatever you may, or whatever you want. Full, I think, is pretty self-explanatory. You just keep the trade till you hit the RR. Now I just did this chart, so keeping your risk to reward, your RR, is super important in coming with a plan, because it needs to be the same thing every time according to your win rate. I'm not going to go over it all, it's all right here, but understanding where your win rate falls into, you should be following your risk to reward every trade. Now, if you're doing a prop firm, so prop firms are 10% drawdown, and you're risking 1% every trade. You only have 10 trades. Now, if you understand how clusters and mathematics work out, it's very possible for you to lose 10 trades in a row, right? Very possible, especially depending on your risk, right? 1%, 10 trades. Now, if you do 0.5%, you get a lot more trades. You get 20 trades, less stressful, and you will most likely be able to make better decisions. The important thing is, when you're trading, is to not feel stressed. And you only feel stressed is when you're over risking, right? You ever felt stressed when you're risking 0.5, 0.2% of an account? No, you don't, because it's a small portion of your account, but with big gains to be had, right? So if let's say you're trading a 50K account, you're risking negative 250 and you're doing a 1 to 4, it'll only take you 5 trades, 5 winners to get 10%, which is typically well, I'm pretty sure all prop firms require 10% on the first phase, second phase 5%. But if you're trading a 1 to 4, this is a lot more reasonable, a lot more achievable than going 500, going for 2,000, and only having 10 trades to do it. This is why trade management, understanding the mathematics behind your system, is so important. It's incredibly important. And then, how do you treat your trading system? Are you partial because you want to lock in what you've had, or are you okay with taking a loss although you were 1 to 3 up? It's up to your discretion. And that's all I really have for creating a trading plan that's going to be profitable, and how you can create one using these 3 imperative aspects in trading.